Thank you very much for joining us at this session of Small Cap Investing Summit 2014. It's my pleasure to introduce Matt Miller, Managing Member of Boyles Asset Management. Matt and his partner Joe Coster started Boyles last year after spending nearly 10 years with Chanticleer Holdings, which is a publicly listed investment vehicle led by Mike Pruitt. Matt co-managed one of Chanticleer's investment portfolios since its inception in 2007, and that portfolio became part of Boyles when Matt and Joe left in 2013. Boyles has a small and micro-cap focus, so we're very excited to have Matt's perspective at this conference. Today, Matt will share with us his favorite current investment idea, which is a company listed in Australia and has a market capitalization of just over 40 million US dollars after a roughly 30% share price decline over the last month. So a very timely idea, and look forward to hearing from Matt why there is a significant value in the equity relative to the recent price. And with that, Matt, I want to hand it over to you for your remarks. Please take it away.
Oliver, well, thank you. Good morning to everyone. Just start out by thanking John and Oliver at valueconferences.com for the opportunity to present today. Sharing ideas and small cap ideas is a pretty valuable service, I think, for most investors, so we're happy to be part of it and happy to be part of what is a very good model. As Oliver mentioned, my name is Matt Miller at Boyles Asset Management. We launched last year in 2013, and I'll be happy to take you through one of our favorite investment ideas at the moment. The standard disclaimer here, I think pretty much everyone has seen the disclaimers before. This is not a solicitation to invest with Boyles Asset Management or in any particular investment idea. It's really for general information purposes only. And I should point out that Boyles Asset Management manages a fund that owns shares in the company that's mentioned, and we may buy or sell shares at any point in the future. With that, I'll get right to the presentation. Here's a brief outline of what I hope to go over with you today. We're going to start with just a really quick introduction to Boyles. Oliver did a good job with that, but I'll just share a little bit more there. And then we'll get right into one of our favorite investment ideas, and it's really broken down into a few different parts. We're going to provide an introduction to the idea and the people that are involved. We'll talk about some of their core businesses. We'll talk about some of the recent acquisitions and investments the company's made, and then we'll wrap up with a discussion of the recent events and a summary. I'll note that in the appendix I do provide a fair bit of the financial backup for kind of some of the summary data that I provide. I won't really go through that, but I provide that for your information if you'd like to go through that. So a quick introduction to Boyles. We did launch last year. We launched Boyles in April, and the fund started on May 10th. I co-manage the fund with Joe Coster, who I've known now for about 10 years. We've been working together in an investment management capacity for the last 8 years. You might also know Joe from his blog, which has a bit of a following, valueinvestingworld.com. We, as Oliver mentioned, managed a fund at Chanticleer Advisors since its inception in 2007. So we have been through the global financial crisis and have managed through that. We launched Boyles Fund 1, as I said, in May with the support of an institutional seed investor that committed $25 million in capital, and we later merged the prior fund that we managed into Boyles. So currently our assets are about $29 million at the end of 2013. Just to give you a brief overview of our investment philosophy to put this whole investment idea in perspective, we do take a patient, long-term approach to investing. If you look at our turnover, our history suggests 4 to 5 years worth of holding periods. We even think longer than that, but that has tended to be the time frame where our investments have materialized and we've moved on. We run a concentrated portfolio. We tend to have 10 to 12 core names. Position sizes are generally in that 5 to 10% range of capital, though occasionally we are above or below that. We are not exclusive to small and micro caps, but that is where we primarily focus. We are looking for significant discrepancies between price and value, and you're just able to find those ideas more often in the small and micro cap area. And with our capital base, we think it's an area that we can take advantage of. We also work around the globe. We look pretty much anywhere, but we do have a focus primarily on English-speaking, English common law background countries. So if you look at our portfolio, it's generally going to be the U.S., Canada, UK, Australia, with a couple of other countries mixed in there. We also tend to hold a fair bit of cash. We're not afraid to hold cash. If you look at the funds that we've managed over the last 5 years, we've averaged actually about 37% cash over the last 5 years. And so we appreciate the option value of that cash. And as most value investors, we are research oriented, and we try to know a business as best could be hoped from an outside minority position. So quickly getting into the investment idea we'd like to present to you today. Zycom Group Limited. Zycom's a small industrial conglomerate, and it has a few emerging technology businesses that I'll get into. It's traded in Australia, but is actually headquartered in Singapore, and it's managed by an owner-operator named Jiak Lak Sim, who owns 36% of the company. I've written out really what our summary thesis is, and this is something that we like to do, and I won't just read it to you, but you can certainly read it. There's really 5 key points to the investment thesis, which is that, firstly, it's a cheap opportunity to partner with an owner-operator, an attribute that we like to look for. It's got a strong balance sheet and is experiencing a late cycle cyclical upturn in one of its core businesses that I'll get into. And we see large potential upside from some of the disruptive technologies that I'll also talk about. Really nearly free call options on substantial businesses. The company trades at a fraction of tangible book value and a mid-single digit earnings multiple. And you get all that with a dividend yield that we think is attractive in the mid-4% range. And I'll also note that is actually not subject to any Australian withholding tax, and I'll mention that further later in the presentation. We came across Zycom actually back in late 2010, began to do our research. It popped up on a price to tangible book value screen that was focused on the Australian market. We did a fair bit of work on it, got pretty interested, and began to buy a few shares at the time. Not nearly enough. The stock proceeded to triple over the next 3 to 5 months or so, and so we didn't really get to participate in it in a meaningful way, but we kept an eye on it and have followed it ever since. As a side note, I think everybody would be interesting to hear something that we've added to our investment checklist, which is that if you ever hear the word sexy associated with your company, it's probably time to move on. After that triple, the media caught attention with the name and started to label this one of its sexiest stocks. So that pretty much coincided with the top in the shares. So add that one to your to your checklist. So moving on to a financial and valuation overview, the shares, when I put the slides together, were trading at 21.5 cents for a market cap of 46 million or so. The company has net cash at the time of a little over 6 million, resulting in an enterprise value of just under 41 million. These financial metrics are as of the year ended June 30th, 2013, which is the last available data. So I think the thing that I would point out is the price to tangible book value, which is at 72%, and the price to net operating profit after tax, which is at 6.3 times. And I would note finally that there are figures in the presentation that are both Australian dollars and Singapore dollars, and I've tried to note that the company reports in Singapore dollars. Everything on this slide is Australian dollars. So an introduction to the founder and family operator. Jiaklok Sim, as I mentioned, is the family head. He founded the business in the late 70s. It is clearly a family business. There are 2 sons and 3 brothers involved in the business at the moment. A couple of the folks that I would point out, Kakwi Sim, who is the eldest son. I think he is probably the person to take over for his father at some point. Him and his brother were both educated in the U.S. Kakwi actually went to Columbia University there in New York. As I mentioned, there's 3 brothers, one of which, Juat Kun Sim, actually sold to Zycom one of the businesses that it owns, Sysmac, which we believe was on attractive or at least fairly commercial terms. We recognize this can be a concern for some investors, but I think in this case the company has respected minority rights. They provide some detailed commentary. They've done rights offerings instead of inside share deals. They're not retaining all the cash. They're paying a nice dividend. In fact, Jiak gets 100% of his base salary in dividends at the current rate. And we have some strong insider ownership that I also talk about here. So Jiaklok owns about 36% of the shares outstanding. He's been a big believer in the shares over the last 5 years. Since 2007, he's frozen his base salary at 432,000 Singapore dollars, and he's bought or made significant commitments to the stock. He's purchased through himself and his family company, which is SNS Holdings, 10.8 million shares for $2.2 million since 2008. That's $2.2 million rather versus 2.6 million Singapore dollars in base compensation during that period. So he's essentially bought shares that represent his entire base salary over that period of time. He's also exercised his option to acquire 4.5 million shares in lieu of cash bonuses. He's entitled to up to 50% of his bonus in shares. The brothers and son own a collective additional 14%, so the family is interested in about 50% of the shares. We've been told that, quote, the chairman enjoys buying the shares below NTA, net tangible assets, and this, I think, speaks to that. So a brief company history. I won't go through all these. A couple things to point out. As I mentioned, he launched the company in 1978. In 2006, they merged the Zycom Australian businesses with the private Zycom Singapore businesses, and the group changed its name to Zycom Group, and that is the entity which exists today. In 2006, they began to acquire Sysmac, which, as mentioned, was from the brother. And in 2010, an important note is the company began to invest in what it called emerging technologies. So the base segments, at the moment, there are four base segments: offshore marine, oil and gas machinery, construction equipment, precision engineering and automation, and industrial and mobile hydraulics. The first of those is the most important. That's offshore marine. This is the largest business and the most profitable business. They provide deck equipment, which is primarily winches in support of oil and gas exploration and infrastructure. Their winches go typically on support ships for offshore oil and gas exploration and infrastructure. These are typically used in really three markets: anchor handling, towing, and mooring of vessels. They also have a small fluid regulating business. And really, offshore oil rig construction is the leading indicator for this business. And I'll talk a little bit about that later. One more thing on that segment. This is the segment that's experiencing a late cyclical upturn. That's an important part of our thesis. The construction equipment business is they produce transit concrete mixers. They actually don't produce a full concrete truck, but they produce the mixer that's on the back of that, and I'll show you a picture here shortly. They're the biggest in Australia and one of the largest in Southeast Asia. The construction business is a little bit levered to Australia, which is a risk, but that business is already down pretty meaningfully. Precision engineering, this is a business historically has the lowest margins. It's where the disruptive investments are being made, and it has a fair bit of exposure to mobile devices, smartphones, tablets. And what they're really doing here is building and designing equipment that's used in production lines. The four core end markets that they talk about are semiconductors, biomedical products, electronic equipment, and as I mentioned, consumer electronics. The industrial business is by far the smallest business. Has decent margins relative to the other segments, but relatively small, and they produce drive systems for harvesting machines. It's an agriculture-related business. So here's some of the pictures just to give you an idea. On the top three are the winch and winch systems. These are big orders, big systems, $1 million to $3 million types of installations, but it gives you a little perspective there. In the middle, you see their cement mixer brand, Sesco, and again, they produce just the mixer on the back. Moving on, you can see some of their construction equipment in the middle right, which is a pile driver. And then on the bottom, we have some of the production equipment that comes out of the precision engineering segment, and a harvester. They don't make the whole harvester, just the drivetrain for that. So segment overview in terms of revenue. You can see it's kind of split about evenly, one-third, one-third, one-third of the three big segments. One of the things that I think to point out is that the marine business has been bigger in the past. It's at points in the past, it's been 57% of the business. I'd also point out that the precision engineering business has been growing nicely, though it does have the lowest margins. It's gone from about 10% of the business in 06 to 09 to nearly one-third of the business in 2013. And as mentioned, the marine business has the best cyclical prospects. Here's the actual revenue. You can see that it's essentially flat over the last 5 years, flat to slightly down. And that's reflective of the cyclical declines that we're coming off of the marine business. It's reflective of the growth that's making up for that in the precision engineering, and it is also reflective of some of the recent declines in construction. The prior peak marine revenue was actually 78 million Singapore dollars versus 42 million in 2013. That gives you some perspective of the cyclical opportunity here in terms of revenue. And as mentioned, the precision engineering, they've actually tripled that revenue since 07. Here's a look at the segments on operating income. As mentioned, the marine business is the most important segment here, and this is even on a softer year. The company refers to these as segment results. It's really operating income. You can clearly see that the better margins are in the marine offshore business and the hydraulics. And over the last 8 years, the marine business has actually averaged about 60% of the total operating income at the segment level. So you can see, again, that there is some opportunity there. Here are those operating margins over the last 8 years to give you some perspective of what's been going on over a longer period of time. Really, the one that is different recently than its long-term average is the marine business. In 2012, that segment margin was 5.6%. In 2013, it was 10.8%. So we're clearly operating well below the segment margin capacity. And one more look at the segments. They also outline their segments based on the revenue, where it's coming from. Clearly, the biggest segments are Singapore and U.S. Denominated revenue. That's a little over 50% of the business. But you can also see that they have exposure to Australia, Malaysia, and China being 3 of the other big business areas. Just one more comment there. There's been some meaningful growth in the U.S. business over the years. That business has grown from 2.5 million Singapore dollars to 25 million dollars, and that's since 2007. We believe the precision engineering is the driver there, with some help from the offshore market. So you also notice that there's a relatively small exposure to Australia, despite the fact that the business is traded in Australia. And the other thing that is not captured in this slide is that the marine offshore business is really a global business. And so while a lot of that comes from the Singapore and China segment, that's really a global business driven by global offshore demand. Moving on to the cyclical tailwind here, I think this is an important part of the thesis. On the left, we have a chart of the confirmed orders, or really backlog. And what if you look at the bottom of that chart at the end of December, you'll notice that there's been a surge in the confirmed orders to 80.6 million. This is the highest since 2010. Sequentially, it's one of the largest changes on record, and year over year, it is the largest increase on record. And so I think that's an important consideration. The acceleration is really beginning to gain steam. The company announces confirmed orders at their annual meeting, which is in November, and so they did that again this year. And the total confirmed orders from November to the beginning of November to the end of December were up just about a third. So there's really a meaningful acceleration in confirmed orders here that's important. We're still well below the prior peak of 159 million. I'm not sure we'll get there. There were some project revenues there in one of the segments that I'm not sure will be repeated. But it does go to show there's meaningful upside even beyond where the confirmed orders have gone to. And when you look at the confirmed orders on a half-year basis, at the end of December, the orders for the rest of this current year were the second highest on record, and only about $1.5 million below the 2010 peak. So we suspect the H2 will be quite strong, and I'll talk about that a little bit later. On the right, you can kind of see some of the recent order trends in offshore rigs. As I mentioned, this is one of the leading indicators. The company tends to operate with quite a lag, maybe 1 to 2 years, and it's looking like it's more in that 2 to 2+ range in this cycle. in terms of a pickup in orders relative to orders for offshore rigs. So I think this is an important slide, an important part of the thesis. So finally, there's a couple core segment notes here. I'll just point out a couple things. The offshore marine peak EBIT gives some idea of the cyclical leverage possible. The peak was 15.5 million versus 4.5 million in 2013. So that's an $11 million potential upcycle swing. And again, this is on a market cap or an enterprise value rather that's about 40 million. The other thing I'll point out is the ROE. The business is trading below tangible book, but I do not believe it's because we're dealing with a poor business with poor economics. ROE has averaged just under 16% over the last 5 years, and they've compounded tangible book value over that period at about 14%. And this is reflective of a little bit better balance sheet and also some investment in the disruptive businesses that I'll talk about next. So their acquisition philosophy, I've been able to discern really 6 key components to the investment philosophy. And this comes from interviews, it comes from some documentaries that I've been able to find in conversations with the company. But they like to be able to add value to their acquisitions. Jacques Locke made the quote that the Kennedy quote there that you should ask not what your country can do for you, ask what you can do for your country. And Zycom likes to add value lest it become a one-way street. The acquisitions have to be synergistic with Zycom capabilities. And importantly, number 3, I'll point out the startup investments have to present what they call, quote, disruptive technologies. And that's important on the next several slides. They also want to be able to have enough internal resources to finance the acquisitions or investments up to the objectives they have for it. They also have a general policy of not investing more than 10% of their net worth in an acquisition or investment, so that's not set in stone. And I like the last quote there, number 6. Obviously, acquisitions are not just about numbers. Jacques Locke's quote is that people create numbers, which is I think a pretty wise phrase. So where this becomes important is the disruptive technologies that they've invested in starting in 2010. They've made 4 such investments. 3 were in 2010, those being Orion, Biobot, and Curiox. IP Tech was made back in 2013. So these are businesses that, again, are labeled disruptive for a purpose. They are venture capital oriented, really. You can see the investments made in each of those businesses. And I'll just go through them here briefly. Orion is a solutions and equipment provider for flip chip electronic assembly, and that's a new process that's being really driven by the demand for smaller and faster devices. These production equipment, this production equipment rather, would be sold into semiconductor manufacturers and assembly companies, and this one is close to some substantial revenue. There's been some indications that they've been trying to negotiate a large first order of $10 million there. Biobot Surgical is a surgical robot business that's first targeting prostate biopsies. The product has undergone live trials at Singapore General Hospital, which is the largest public hospital in Singapore and also the 3rd largest teaching hospital in the world. The aim there is to reduce infections and improve accuracy of diagnosis. It's actually received regulatory approval in the U.S., the EU, Australia, Singapore, and Taiwan, and they've been negotiating international hospital partnerships over the last year. Curiox is a product targeted at pharmaceutical and biotech companies. They call it a wall-less plate and washing machine. It's used in drug research and discovery. This one is also fairly advanced in terms of close to being a revenue generator. It's been accepted, quote, as breakthrough by 10 of the top 25 pharma and biotech companies in the U.S. and EU. IP Tech was a recent investment. This company is really a services business. The company received a grant from Spring Singapore, which is a subsidiary of the Ministry of Trade. It was a $4.5 million grant to start this business with $2 million of Zycom investment. And this will be able to, this company will offer medical intellectual property translation services. So this is prototyping, design, regulatory consulting, and manufacturing. And this really, we think, validates some of the company's investments over the last few years and really speaks to what they've done with BioBot Surgical. As you can see, these are clearly venture capital in nature. These are businesses where they are really trying to disrupt a particular industry. They have significant barriers to entry, being regulatory barriers, intellectual property development barriers, commercial acceptance and adoption, and rigorous performance and quality standards. So these are not simple investments. The collective investment through the four businesses has been Singapore 15 million. So a fairly substantial collective investment relative to the company's current market cap. If you go over time, the commentary on these businesses, it's pretty clear that the company thought they'd be commercial a little bit faster. They've been in the businesses for 3 years. Collectively, the three businesses that they made in 2010 have not yet generated meaningful revenue, but I think we're getting closer and closer. But it is clear that these could all be failures. They could all be zeros, and we're prepared to deal with that outcome. In terms of thinking about a realistic upside, if you look at a potential return on that collective investment of $15 million of 20% after tax, the incremental net income potential would be Australian $3.5 million, which again is pretty significant relative to the current run rate of earnings and the current enterprise value of the business. And so that's kind of how we look at the potential here. But we do respect the fact that any one of these businesses could be as large as the entire core businesses at the moment. In our Q4 to letters this past year, we actually talked about the need for investors to have a quote reasonable imagination, and I think that's particularly important with these disruptive technologies. The potential here is quite large. Again, we don't think we're paying a huge amount for that potential. But again, I will admit that valuing these businesses is quite difficult, and they all certainly could be zeros. And getting into kind of toward the end of the presentation here, I'd like to talk about what was a recent profit warning, which you can see has caused a pretty meaningful decline in the share price. It was starting to catch some attention going into this profit warning, but the profit warning was pretty severe. They expect H1 revenue to be down a little over 14%, and H1 earnings to be down about 76%. Which is pretty dramatic and is certainly reflective of a tough period. They've talked about delays in the disruptive technology businesses, a slow period for the marine business, and also a slow period for the precision engineering business. I think the two important things to take out from a positive perspective on the profit warning were the cash in hand, which is now up to $25 million Singapore. That's going to be about $22 million Australian, so the cash flow has ramped up pretty dramatically. And the confirmed orders, as I've alluded to earlier, ramped up pretty dramatically as well to $80.6 million Singapore dollars. So while the market has punished the stock here, I think the cash and confirmed orders are really two important things to consider. The company said that based on the confirmed orders, the slack is expected to pick up in the second half of the year, and that they're hopeful of maintaining profits for the full year at the same level as 2013. And barring no unforeseen circumstances, the results could be improved. And I actually think that is a pretty likely outcome when you look at the confirmed orders that will be delivered in H2 relative to other periods of similar confirmed orders. It does go to support the contention that 2014 revenues could be at or above 2013 revenues. I'd also point out that 2013 full year earnings were impacted by a fairly substantial currency loss that we don't necessarily expect to recur this year. So again, just kind of wrapping that profit warning up. It wasn't a great half. We like the cash generation and the confirmed orders, and we do believe that based on those confirmed orders that earnings in 2014 should approximate or exceed 2013. Some final notes. We've talked a little bit about the balance sheet. We've talked about the fact that it's traded in Australia but not headquartered in Australia, so the dividend is actually paid out of what is called conduit foreign income, so it is not subject to any withholding taxes. I'd also point out that an important consideration is currencies and the movement between the Australian dollar and the Singapore dollar. The Australian dollar has not only weakened against the US dollar, but has weakened fairly materially against the Singapore dollar. So on a translation basis, that does provide some support for earnings and book value when you're buying this stock in Australian dollars. So at the end of December, 1 Singapore dollar bought 89 cents worth of Australian dollars. That was at 86 at the end of the prior fiscal year. That would actually add a penny to tangible book value and drive the price to tangible book value ratio down even further. I talked about just finally that the company was repurchasing some shares a few years ago. The company unfortunately has stopped doing that as it kind of began to be frustrated by the lack of respect that action got in the market. I don't agree with that, but that is probably the one move that I do disagree with most. Quickly on some risk discussions, there are a number of those. If the late cycle marine offshore pickup doesn't materialize, that would be a big risk. Or if that improvement is just offset by declines in the construction business, that would also be a problem. And then the big one is the disruptive technologies. If these do not begin to bear fruit or they become a further drag on profitability, that would be a material risk to the investment going forward. And it's certainly possible that the company makes additional investments here. We also talk about the family nature of the business being a risk if it becomes an impediment to commercial success and progress. That is certainly a risk as well. So just to conclude, we think ZGL is cheap on current earnings, average earnings, and book value. It provides an opportunity to partner with a committed owner-operator. One of its core businesses is experiencing what we believe is a late cycle cyclical upturn. We also have the opportunity to benefit from potential high-impact investments that the company has made in disruptive technologies. These would be higher quality, higher growth, less cyclical businesses if they are successful. And we also appreciate the balance sheet, which provides significant opportunities for further investment. And so with that, Oliver, I'd be happy to take any questions you might have.
Well, Matt, thank you so much for sharing this idea with us and for all the detail that you've gone through to make your investment case. It's much appreciated. And I'd like to refer anybody in the audience with questions for Matt to get in touch with him directly at the contact details provided here. Matt, I have a few questions myself. As you were presenting your case, I was just curious. You made references a few times, I think, to speaking with the company, and I was curious if you could describe a bit that experience and just how accessible the management is, and whether you've had access with the main shareholder as well.
Sure. So I've actually had a few conversations with the son that we believe is the person to take over for Geoclock. So I've had several conversations with him, and there is a little bit of dialogue there that I'm referring to Kakui Sim, the son. The management team overall is, I would describe them as somewhat accessible. I think over time they've grown perhaps a little bit less accessible. They're open to receiving questions via email, but they've become a little bit hesitant to talk with someone like me on my own. Without a broad audience. They're really careful about not wanting to share anything that could be remotely considered inside information, and of course we're not looking for inside information, but they are really cautious there. So the investor relations is open to receiving questions on the financials and strategy via email, and that's something we've done. I've also had a close friend in Singapore who has met in person with Kakui Sim, the son, and that conversation and meeting has really reiterated the big points that I took from our personal conversation. So I'd say from a management accessibility perspective, it's mixed. We'd like it to be better, but we think the company, the insiders' purchase of shares and the results will speak for themselves. But I think, to be fair, we would appreciate more insider dialogue.
And the other thing that sort of got me interested is obviously a very compelling sort of valuation figures and the setup as you've described with these disruptive technology investments that you're not really paying for, but that could be a nice option. Along those lines, so it seems to me just a very complex sort of business spanning different geographies, many different sort of businesses and markets, customers, for a size of that this company is. So it's sort of it's a question, I guess, about capital allocation, which on the one hand they're doing some things well, but on the other hand it seems like a sort of conglomerate structure that's that carries some risks in terms of focus and leakage. How do you see that? I guess relative to the price you're paying, how do you see that?
Yeah, no, I think that's an important consideration. There is no doubt that this is a small conglomerate. So I think that's certainly something an investor has to be comfortable with. Excuse me, they have to be comfortable with the management oversight. I would argue that from a capital allocation perspective, the company has done a fair job. I'd like to see them, continuing to buy back shares. The jury is still out on some of the disruptive technologies. Lok Sim, who is the large shareholder, is personally involved with each of these new businesses, and so that's where he spends a lot of his time and energy and efforts. I think the other core businesses, as you allude to, are pretty diverse, both in scope and geography. But I think the company has proven to manage those issues well over the last several years, and it's certainly a consideration. But I think relative to buying the company at a fraction of tangible book value, I think we're willing to accept that risk. So it's trading about 72% of tangible book value. If you look at some of the currency movements and some of the anticipated profitability from this fiscal year, which we're now only 5 months from completing, you're looking at buying the shares at under 70% of tangible book value, and this is for a business that's compounded tangible book value at least acceptable rates. So I think relative to the price being paid, it's a risk we're willing to assume, especially for the potential opportunities involved in these disruptive businesses.
And can you give us any further detail on the oil and gas segment, the related segment there, in terms of the winches, I think, as you described them? Is there anything proprietary in terms of that technology, or anything that's sort of common among the various sectors that they're in, the various products they're making, in terms of the underlying technology expertise? Anything that could be really valuable there? And related to that, I guess, who are the customers in the oil and gas segment? It seems that this is quite an important part for their customers to make sure the operations go smoothly. Yet this is such a small company, and I'm curious how you see that.
Yeah. So in the marine business, there's not what I would describe as large barriers to entry there. Certainly there is design considerations. The biggest consideration in that business is that these products operate in extreme environments with extreme stresses, and they're out on oceans and waterways, and they're big, heavy equipment, and failure is not a particularly good option, especially when you're working in conjunction with a large offshore platform. We all know the hundreds of thousands of dollars that those tend to go for on a daily rate. So it's not a huge barrier to entry, but there is a demanding aspect of the equipment that's involved there. Actually, one of their competitors, believe it or not, is Rolls-Royce, which owns a deck machinery business as a subsidiary of theirs. But again, so not huge barriers, but some intellectual property and some performance attributes that you can't really mess with. In terms of its customers, they're mostly the shipbuilders and barge builders of Southeast Asia. So that's Singapore, China. I think a little bit to Korea. So you're going to want to keep an eye on the order books for not only for the offshore rigs, but also the folks that support the offshore rigs, being some of the shipbuilder books.
And just lastly, to come back to the owner-operator, I was curious if you had any indication as to any other business interests that they may have, or do you feel confident that this is really their main vehicle for their own family capital?
Yeah, I believe this is the main vehicle for their family capital. I have been led to believe that Geoc does have a few investments outside of this, some public holdings, but that they're relatively minor relative to his stake in Zycom here. I've been led to believe that those investments are a little bit more venture capital in nature and in non-operated venture capital. So if you look at the disruptive businesses that Geoc has gotten Zycom into, these are really, and I should have made this point, really control investments. So if you look at the 4 investments that were made, they all have at least, I believe it's at least 50% ownership, and a couple of them have substantial majority ownership, where there's a small piece that's owned by the management of those individual businesses. So these are, I should have pointed this out, but these are not minority investments. These are businesses that are really controlled investments, controlled venture capital. And Geoc really likes to get his hands down and in things. He relates the story about when he made one of his first acquisitions in Australia. He actually spent 6 months working on the factory floor and working with engineers in the management of that business, so that he knew every piece and inch of that business. And so he's a guy who has an accounting background, but he has developed an engineering background as well, and he really gets involved with these businesses. So these are not simple minority businesses. They are really controlled businesses that they're involved here.
Well, with that, Matt, I want to thank you again so much for sharing this idea with us.